Hey everybody, I'm Michael Smith, and welcome to the last show of the year. Brought in Chris Roberts today to help me expand on some key themes and catalysts for 2024. Chris, let's get right into one of the biggest ones I think is on everyone's mind. One of the ones we all have seen many examples of, but that's inflation. Mm-hmm. What do we start thinking about inflation for 2024?
Yeah, the big theme for 2024 is going to be inflation moderation, if you will, right? So
finally,
finally, right. So we've seen some, quite a bit of, disinflation, if you will, in goods, right? We've seen the rate of inflation on hard goods come down quite a bit. But I think the key theme for 2024 is how sticky, the service inflation is going to be, right? So we're not really talking about things like, furnishings or household goods or things like that. We're talking about your Netflix subscription. We're talking about the fact that, NFL Sunday Ticket went up over 16% from 2022 to 2023. Typically those tend to be a little bit stickier because consumers are less likely to cut a service as it goes up in price, right? You get kind of married to having that service. I think Netflix proved it, speaking of them, not to pick on them, but they proved it with the password crackdown this year, right?
Yes.
They lost subscribers, but I had a shared account and I am now on my own account, right?
Yeah.
I valued that service enough to pay the higher cost because, again, services are sticky with people. They get used to them. So, I think that's going to be the key theme is continued goods, inflation rolling over, and then how sticky is that service inflation?
One thing I'll add about service inflation is yes, it did go higher, but it's probably likely going to stay at this level for quite some time, and that'll just kind of average out later on. So that's one thing about service inflation. It scares you, it jumps up quickly, but it'll probably moderate here for a while.
Exactly. What is going to be the annualized rate of inflation on services 5 years from now? If we take it from the start of 2022 to, let's say going to the end of 27 or even 28, what's the annualized inflation rate? And so you're right. We could have seen massive increases over the last 12 to 18 months, and then maybe those moderate or become non-existent, over the next few years. They've squeezed as much as they can. But again, people really like their services, so it's easy to raise prices there. So that's going to be, one big theme is just if the Fed is right, is that they're winning their inflation battle. The service side of the economy is really where they're going to be focused.
So inflation being a big scare as it's been in the past is probably, again, likely to be less of an issue going into 2024.
Absolutely. Yeah.
Now, Chris, let's get into the consumer. I mean, this is one of the biggest drivers of GDP. 70% of GDP is made up by the consumer. The health of the consumer. What does that outlook start to look like in 2024, maybe in comparison to what we've seen so far this year?
And the theme for 2024, as it comes to the consumer, is it deteriorating? Is the consumer deteriorating, or are we seeing confidence? Right, because if you look at a number of forward-looking economic indicators, household savings rates, credit card debt utilization, the amount of underwater vehicle loans, auto loans that are out there, we got student loans restarting, things like that. Typically, that'd be pretty bearish for consumption, right? That'd be pretty bearish for demand in general, right? But at the same time, we haven't seen demand roll over yet, despite all these potential red flags, and so that could very well be a sign of confidence in people's economic circumstances. I say, well, I'm secure in my job, I'm making more money, my wages have gone up, so maybe I just don't save as much, or it's also kind of revolves around rate expectations too, and I'll let you build on that.
Well, yeah, because I think you're right on that. I mean, is exhaustion or confidence? I mean, I think it has been somewhat confidence. Is that the fact is, people feel like their jobs are somewhat safe. Their income is, definitely gone to some degree, but maybe higher than they've seen in the past. However, that's probably likely to stagnate. I mean, how much more credit can consumers run on? But I think if they feel confident that they're going to maintain their job, maintain their wages, they're going to feel like, especially now with rates going lower, they can kind of probably continue the spending cycle.
And some of those red flags may very well improve if you see rates come down, inflation roll over, right? Those, especially with lower rates, right? Those
reset your credit cards.
Yeah, those revolving doors of credit utilization, that high utilization doesn't look so bad. It turns from a red flag to a yellow flag, if you will. And so there's good things happening on both sides there. But again, it's going to come back to, are we going to see deterioration or continued confidence? And right now the tea leaves are pointing towards continued confidence.
Well, one thing I'll add about the confidence side is, again, one of the biggest things I think is a barometer for the consumer is housing, is their home, right? And of course now, with rates had moving higher, home demand had basically declined or basically stagnated. Now I think if anything, we might see the other end of that, and homes remaining in demand probably boost the consumer confidence even further in 2024.
Yeah, if we can get prices to stay stable on the housing side, rates to come down, more supply to come online. We've seen, if you've driven all around where we are down here in Houston, there's plenty of development.
Yeah.
So if you get those three trends, then that bodes well, especially for younger generations.
Well, Chris, let's get into the markets, right? I mean, volatility has definitely reared its head. I personally think 2024, we're going to have more catalysts for that excess volatility that we've seen, but maybe and also look at the concentration we've seen for 2023. I mean, the Magnificent Seven, the top 10% of stocks right now is responsible for 35% of the
Let's just say
total,
super majority.
Super majority. But so what does that start to look like going into 2024?
So just from a volatility perspective, right? And again, talking about themes or catalysts, right? What are the things that create excess volatility next year, very similar to what we've seen this year too. And so, obviously the consumer recession, right? Do we see the consumer get exhausted? Of course, and then you have a demand recession, you have a more atypical, or I should say typical, recessionary environment. But then also what we've seen throughout 2023, the separation between expectations for monetary easing or rate cuts and those things happening in reality. What the goalposts have been consistently moved throughout the year. If you take us back to the start of 2023, it was rate cuts by mid-2023, and then just that goalpost kept getting moved and moved and moved, and that's why we had those really wild swings, especially through the summer and then into this past fall, and now on the upside, here in November and December with the Santa Claus rally more or less, and then on top of all of that, we also have to take into account we're going into an election year. I actually think that probably adds a little less volatility than maybe some will anticipate, because we, for lack of a better word, we kind of have status quo candidates. We have one person that's running that has been president, and another person that's running that's been president most recently for the last 4 years. So we don't have any really new policy objectives being brought to the table here with an out of left field or right field candidate, so to speak. And then also on top of all that, as we all know, the geopolitical tensions haven't necessarily calmed down. If anything, they've gotten worse, and those can be exacerbated, especially in an election year where people are constantly looking for sound bites.
Well, the world is becoming increasingly more of a dangerous place, so I definitely expect geopolitical catalysts to be out there for 2024. One thing I want to kind of point out here, Chris, is the fear and greed index. And the reason I'm pointing this out is not to start saying, well, it's going to go the other way. It's to be cautious. I think right now you don't want to get ahead of your skis. Don't start taking extra risk out there. I mean, we just saw the S&P, the biggest daily inflows of $20 billion in one day. That's what's driving. So everybody kind of feels like they missed out. They're trying to jump in here, but be cautious. Don't get ahead of your skis. We think there's plenty of volatility to come next year.
And there's plenty of opportunity outside of places like equity markets too. So,
Chris, another topic I want to kind of maybe go into with the Fed basically coming out, pausing, and giving us an indication that there might be 3 rate cuts this year. That helps reignite CapEx spending or capital spending. What do you kind of see on that front for 2024 in addition to?
Well, I mean, that's been the big kind of policy objective too, is this kind of reignition of CapEx spending, especially in things like manufacturing, industry, energy, just generally a more independent economy here in the United States. And that's not uncommon for some of our international allies as well. You've seen this general push towards reshoring and nearshoring and what have you. And so I think you'll likely see some extra momentum there going into 2024. Again, you're in an election year. These are policies that are generally pretty popular on both sides of the aisle. And so because of that, you'll likely see a lot of enthusiasm for those, domestic production policy objectives. And I call them policy objectives because a lot of that is very much so dependent on trade policy and things like that. So it's a big theme for 2024 in that it'll likely continue to be amplified. We've seen it this year. We saw it throughout 2022. It'll be interesting to see how much international trade partners of the United States also begin really leaning on that.
Well, Chris, another big question I have, and I want to see if I want you to expand on this, is the ability for companies to continue with profits. This is the one thing, especially like late cycle. Do these companies continue to see their ability to drive profits into 2024? Where do you see that taking? What do you see taking place there?
Well, when I think about that, Mike, especially from the context of the rally we've seen here lately, is it's profits versus potential, right? Okay. And that's what I mean by that is, we have seen a massive amount of multiple expansion, really throughout 2023, yes. Especially in the Magnificent Seven, right? They have gotten their stock prices have gone up quite a bit, and they don't necessarily have the earnings to support that, right? Which means we're seeing, price to earnings ratios expand, right? We're seeing that multiple get larger without the earnings coming up per se. And so what that is that's just investors saying, hey, with things like, the AI boom and what have you, and just the potential that these companies have, right? We're pricing in that potential. And so I think that I would say that, overall, especially in the Magnificent Seven and just the tech sector in general. Once again, we're seeing things priced for perfection, which means they have to produce results that support those valuations and that high multiple expansion. You could very well see the multiples come down in 2024 if, as earnings results come out, they continue to blow things out of the water. Looking at you, Nvidia continues to blow things out of the blow expectations out of the water and reset the fundamentals. So that's going to be key. But then that also kind of segues into the big wild card, or the big, I would say one of the biggest themes for 2024 and even the years beyond is the productivity wild card.
Yes.
One of the key things that you see with the AI boom is the potential for large corporations to significantly increase productivity levels. And productivity is really the driver of profit in the modern economy.
We're just scratching the surface of, I think everybody by now has used AI or seen it in use to some degree. We all see the potential. But I think we're just at the start, and to piggyback on your productivity increase, do we start to see other corporations now utilizing artificial intelligence to increase their productivity? I think that continues, and I think we're just now at the beginning.
I'll give you a great example, Mike. It happened last night. My wife is working with, she works in medicine, and she's lining up, her salary for next year. They asked, hey, would you do some research into what people in your position make? We'd like to, we want to just do some market research. And she was looking through all these different papers and all these things. And I said, why don't you ask ChatGPT?
Exactly.
She had that data in 30 seconds.
Yep.
And so that's a productivity boost. She could now, set aside and sit down at the dinner table and have dinner, as opposed to studying through this data to try to determine what she should be paid next year, so to speak. But just generally, and I have a term written down in front of me here, and I call it disinflationary economic growth, which, if you, again, think about that for a second, that's kind of a Goldilocks, right? That means you have economic growth, but you actually have, prices potentially retreating for consumers.
Yep.
And not in a bad way, because this is all about productivity expansion. And that's the key, right?
Or stabilizing to some degree.
So going back to, especially the Magnificent Seven, reaching their potential, it all comes back to how much does productivity actually expand with these new technology and these new tools that are evolving every single day. And it's very fascinating from a financial markets perspective, because it's like that those cost inputs could very well plummet.
Well, I think every major corporation has probably got outlined at least somewhere on their agenda at the beginning of the year to see how artificial intelligence can help their productivity of the firm. So I think it's something you're going to continue to see.
It's a fairly bullish trend. Like I've said on the show before, there's socioeconomic impacts as well that have to be taken into consideration. But generally, more profitable companies that can squeeze more dollars out of every employee, an incremental unit of spending. For every dollar you spend, you get X amount of productivity. That expanding is good. Is good for equity markets. It's good for valuations, and it bodes well. Well, Mike, I think I'll take the baton to kick off our final theme here, and it's really just some closing comments more than anything, and that is, I talk with our advisors about this too, and maybe it's the fewer gray hairs I have, whatever it might be, but I think it's important for institutions and individuals and us as advisors to not necessarily fall into the trap of looking at all the trends we see from a classical lens. Yeah. I think that COVID era policy decisions, fiscal and monetary, have really, put a new lens on some of the economic trends, that we are seeing. And one of the biggest trends is that, look, the large driver of some of the, inflation rolling over that we've seen over the last, 12 to 18 months is really supply side driven. Mm-hmm. Typically the Fed raises rates, it clamps down demand, they cause a recession, but inflation comes down. Well, in this case, demand really hasn't gone anywhere, like we've talked about. Yep. We've seen inflation roll over, largely because supply chain bottlenecks have been resolved post-COVID. It takes a long time for those things to resolve themselves, so to speak. So if we're seeing what we want from the inflation side without necessarily a destruction of the consumer, then maybe some of these normal recessionary red flags, they may not be red flags in this context. And so I think it's important that we, look at historical data, because historical data is very helpful, but then also realize that there's not much, there's really not something we can point back to that's similar to the actions and the taken during, the COVID era, for example. And so I just always challenge folks to say, hey, look at things from a slightly different lens and look at where we're seeing a separation versus history.
Yeah, you hear a lot on social media talking about this looks like 2007, or this may look like 93, or whatever it matters. And I think to your point, don't go back and look necessarily all the things that added up then may not add up here. We have a lot of things that are changing. We mentioned AI, a lot of things that are, that may push things a little bit different than we've seen in the past.
Yeah, and I think, those red flag demand indicators, we'll see if those percolate, into a traditional recessionary environment. But, if they don't, and falling rates and inflation also help, prevent that outcome, of a true demand recession, then, the Fed has achieved their goal. And I know I'm not really ready to say that they have. Absolutely not. I think that there's a long way to go, and we still, again, hikes in interest rates take a long time to make their way through the economy. But I think, so far, things are trending really in the best direction we could have hoped for 12 months ago. And so, I'll just leave it there, which is, again, it's yes, the historical context is important, but be sure to also kind of change the way you're looking at these. Don't just fall solely into the historical camp. There might be some new lenses to look at the economy through.
No, I think it's a great point. And you know what, Chris? 2024 is going to be, without a doubt, very exciting. But it's going to be very volatile year. It's going to be lots of different catalysts, lots of different themes, lots of changes out there. It's going to keep us on our toes. And you know what? We'll be here to help you. And appreciate you listening all year. And we're looking forward to seeing you in 2024.